Good morning, everyone. Call to order the Retirement Plan Subcommittee, December 3rd, 2024. Oh,
Yep, we're good.
now we're good. Missed my beautiful preamble. Okay, I guess we will start with the first, number 2 on the agenda, the housekeeping items. Appointment of chair for 2025. So we can do this a number of different ways. We can go through the whole nominating process. Someone can nominate someone. I'm not sure if someone wants to make a suggestion. Otherwise, we can.
Steve, why don't you move to nominate Todd Burke as chair and Heather as vice chair to continue their roles?
I would love to make a motion to nominate Todd Burke as chair and Heather Getz as vice chair.
I would love to second that motion.
Say I would love to, but do you? Okay. All in favor?
Aye.
Aye.
Okay. So I think that's the nomination, and
we're the lucky ones.
yes. Okay.
You won! Yay!
This is great. I'll spare the speeches. Okay. Thanks, everyone. Let's go down now. We've got the chair. We've got the vice chair. Let's go to the regular meeting schedule for 2025. Like to get on the schedule some dates. Since this is quarterly, they kind of get lost in people's calendars. Like to kind of plan as far ahead as possible. So you'll see that the 4 dates proposed, typical Tuesday morning, 8 o'clock, February 4th, May 6th, September 2nd, and December 2nd. Not sure if we have to vote on that, but it says that we agree. So as long as we agree, we'll kind of pencil those in and plan for those dates for the next year.
Todd, I do think you need to vote on those.
Okay. I have a motion for those to approve those dates.
So moved.
Second.
Everyone in favor?
Aye.
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 Okay, I heard all ayes. No nays. That passes. Okay. So thank you very much. And then we'll move on to a review of the minutes. Did anyone have any comments on the minutes? A motion to approve those.
So moved.
Second.
All in favor?
Aye.
Aye.
All ayes. So that's all set. Thanks, everyone. And I will pass it over to Chris.
Well, great. Good morning, everyone. Good to see folks as always. Trust the holiday season has gotten off to a good start for everyone. Before we bring up the slide deck, just quickly, kind of a couple of super high level comments to frame the conversation in the update this morning. We're going to share with you from a governance standpoint on the DB and the OPEB side a little bit of what we've seen statewide among your peer plans, both on the return assumption, investment return assumption standpoint, and then funded statuses. And you'll see that the town sits in kind of very good shape on both fronts. We'll share a little bit on capital markets, which certainly through September had been robust. October and November have been a little bit more mixed, and we'll talk about some of the reasons why. Performance in the plans has been good. I think all of them earned about a 6% return in the third quarter, and pretty healthy returns on a one-year basis as well that we'll share. And then maybe just a final reminder, remember at our earlier meeting, we talked about rotating some of your fixed income capital in the pension plans away from MetWest and Western that we had elevated to terminate statuses for a host of reasons, and redeploying that capital. You'll remember with Dodge and Cox, and then a Hartford strategy that's sub-advised by Wellington. And those actions have all taken hold, and you're up in good working order with respect to those changes. So that's kind of a high level frame for you. Maybe we'll fold in, if no one objects here, a little bit of detail. Let me see. I should be able. No, that's not it. Let me I thought I had this thing teed up here. Bear with me. My Zoom skills are not quite they used to be. I've got it right there. Zoom. Full screen. Share. Oh, there we go. Can folks see that okay?
That looks good.
Yes.
I'll go to full screen mode. There we go. Tyler's going to laugh at me later about my skills on this, but nonetheless, all right, so we'll go quickly here. Hopefully anyone's invited next fall. We'll be remiss if we don't preview our next conference. It'll be fall of 2025 in Boston. Would love to have folks there. We'll keep you reminded of that as the date draws closer, but pretty good sessions in Chicago this year, and I think people came away with finding it to be a very productive day. So capital markets, just quickly here, you'll see on the page a couple of high-level themes that as the autumn timeframe took hold, were kind of guiding and influencing markets. And most noteworthy, of course, was after lots of consternation and waiting, the Fed, as you all know, did finally move on the interest rate front. They cut rates about 50 basis points in September. They followed that with a 25 basis point cut in November. We'll talk a little bit about pacing and what they may do going forward in just a second. We thought it interesting just to catalog for you in the upper right-hand corner of the page previous campaigns, rate relief campaigns, and you can see historically they last about 2 years, and there's on average almost 600 basis points of cuts, 6 percentage points of cuts. We're not going to get there this time, just given the circumstances. As you'll remember, we're at 4.5 to 4.75 guidance from the Fed today on Fed funds. That's after the 75 basis points of cuts. We expect there's maybe another 175, possibly 200 basis points of cuts forthcoming. So we'll be a little bit more muted than the past, but nonetheless meaningful from where we started, and certainly on the other side now of the Fed waiting and watching. And interestingly, right, importantly, in terms of setting up for 2025, you'll see markets, no surprise, like interest rate cuts, all else equal. So you see in the lower left-hand corner of the page here what certain equity and fixed income markets do when the Fed is cutting rates. And generally, you see pretty constructive outcomes. 8, 9, 10, 11% type returns generally. So again, we'll see how those things flesh out with time, but typically it's been productive cycles for capital markets when the Fed is reducing rates. The Fed has a dual challenge, as you'll remember, or a charter, I should say, right? Price stability is one. So you see the upper left-hand corner of the page there. Obviously, they gain comfort from the continued progression on the inflation front. You see those headline inflation numbers now kind of marching back towards the stated 2% target. So while they're not quite there yet, they certainly have rolled things over pretty significantly. And obviously, that directional relief gave them the comfort to begin cutting rates. There are other charges you may remember as full employment, and that's a little bit of a mixed bag if you look in the upper right-hand corner of the page here. The labor markets, I think if you talk to most, are still by and large pretty solid, but there's a small measure of cooling as we evidence there, and you can see that slight uptick in the unemployment rate. Our expectation is the Fed probably spends more time in the coming months evaluating that data, and their interpretation of that data will guide, the pacing and magnitude of those further rate cuts. Less so on what's going on with inflation. So more to come there. But again, we do think they'll continue to cut rates. It's just a matter of how they kind of piece the data together. The backdrop macroeconomically is still a good one. So you see in the lower left-hand corner of the page there, we just run off for you quarterly GDP growth. And you see there it has been fairly stable and positive, and not displayed on the page here, but released recently. I think the third quarter estimate was about 2.8% growth. So the backdrop economically is still a good one, right? You can appreciate the Fed kind of taking some confidence and comfort in that. But in the same token, right, using that as a guidepost as well for further rate relief. They certainly don't want to cut rates to an extent that they reignite inflation if the economic backdrop's still a decent one. So these are kind of the three things, right, that they're going to work their way through in the coming months in terms of how they pace those further rate cuts. And then just finally, so you've got it here, then it's a little dated, we'll roll it forward for you in a minute, but you see on the top half of the page, capital market outcomes for both the third quarter and the year to date, and right, a pretty good year to date numbers by and large, right? Positive returns for both fixed income and equities, and moreover, some of the diversifying asset classes like real assets and REITs and commodities and the like. Maybe the one thing of note and interest here, kind of under the hood, maybe not obvious, but if you look in the middle of the chart here for global equity returns, look under the third quarter numbers are interesting, right? Because for the first time in quite some time, you see small cap and both developed and emerging markets outpacing U.S. large cap equity, which, as you all know, had been certainly the source of strength for several quarters running, and certainly still in the lead on a year-to-date basis. But nonetheless, that rotation, kind of interesting and of note, we do have an expectation that if the Fed rate campaign continues to unfold as we think it might, and the economy, hold serve here as we think it might, that broadening of returns is something that might come with a bit more stability, and for a diversified program like you folks have, that's, I think, a kind of an encouraging outcome and backdrop. So more to come there. And again, not on the page here, I don't want to confuse you with too many numbers, but as October and November have been a bit of a mixed bag. October actually was a period of a little bit of consolidation in global markets. Fixed income was down a good measure as rates spiked a little bit, on the heels of the election and some noise there. And equities were down a little bit globally. In November, we've seen kind of a return and some stability. Fixed income in U.S. markets have kind of stabilized and moved higher. International markets moving a little bit sideways. So we'll obviously flesh that all out for you in the next report, but kind of a mixed fourth quarter to date anyways. Certainly when you roll everything forward and look at the year-to-date numbers on a calendar basis through November, they're still pretty encouraging, and it looks like, unless December goes crazy, we'll have a pretty decent calendar year. Let me pause there for just a minute. Any questions from the committee on big picture stuff before we segue over to the portfolios?
I do. Todd, can I ask?
Absolutely.
Two things. One, thank you for that. Just as we're starting to enter the budget process, do you have any predictions, projections on money market rates and CD rates for 2025?
Yeah, they're gonna, Lisa, continue to probably come down, right? They move. I don't want to say an absolute lockstep, right, with what the Fed's doing, but the Fed, as you all remember, does influence the front end of the yield curve, and money market rates and CD rates ultimately trigger off of that. So I think money market rates today are somewhere, depending on the fund, about 4.25, something like that today, right? If the Fed continues to cut rates, you should expect those money market rates to kind of come down as well, right? And again, it might not be perfectly in lockstep, but if we get another, 75 basis points of cuts in the next, 6-9 months, mid threes for money market rates is probably all else equal where we end up, right? And
Okay.
somewhat similarly for CDs. So
Same for CDs, about 3.5.
yeah, I mean, CDs kind of run the gamut a little bit. I would do more work there for you if you want a precise answer, but generally, yes, I think all of those short-term rates.
So in terms of our budgeting, 3.5 is a reasonable number from your perspective.
Yeah, and the other thing I think, Lisa, that folks look at, Amy or Kelsey can jump in here, right? And we can help you with this. STIF, the Connecticut State Short-Term Fund, right, is a benchmark that a lot of towns use for, their cash warehousing. I didn't look, I don't remember where they are today, but generally, directionally, right, it's going to be the same thing as those short rates come down their yield will come down a bit as well. Again, I'm not quite sure where they are today. It might be a little bit north of money rates, if I remember, but not dramatically so. But I do think the pressure's down, right? I think all else equal, if the Fed continues to do what they intend to do, you're going to have lower, yields for those capital preservation products.
And just for anyone who's watching, your projection for year-end investment return? I know it's in the package, but if you could just say it.
Yeah, I will, well, we'll look here in a second. We were up, upper single digits, I think, through September calendar year to date or thereabouts. We run flat for December, right? I don't know, probably, 8, 9, maybe 10% type returns for the calendar year if everything holds.
And just for members of the public, our assumption rate is 6.5, so
Yeah.
doing above projections.
And on a fiscal, I don't have, we'll look at them, Lisa, right? I don't have the fiscal year number right on the tip of my tongue. The 1 year number through September for your plans is, 20% and north of that. But remember that some of that rolls off so there's a little bit of noise there. But I think the general takeaway is that it's been surprisingly, capital markets have been resilient and returns have followed, a suit, and your plans have done well.
Chris, just also for members of the public, why is it important that we look at both the calendar year and the fiscal year? It's the fiscal year goes towards our ARC payment. Can you just talk a little bit about that?
Yeah, right. I don't want to, I won't, stand in front of the actuaries, can probably give you a more elegant answer, right? But we kind of think and frame our performance comparisons along, Lisa, as you mentioned, those 2 time frames. Fiscal years, the guidepost, right, with budgets and kind of the larger financial circumstances of the town and ultimately the plans and, what you need to do in the form of contributions and whatnot. And that 6.5% guidepost that you mentioned is kind of how we target building the program, allocating assets, right? Selecting managers, all is a byproduct of trying to get to that 6.5% fiscal year to fiscal year. Calendar years is just, more intuitively for everyone on the call and anyone listening in, right? I think is the way people kind of frame in their head how markets are doing, right? Just it's a good year, it's a bad year. You'll remember 2022 calendar year was a god-awful year. 2023 was a year of improvement, and it looks like calendar year 2024 again is going to be, at all else equal, a pretty nice year for investment returns. And I think it's probably, again, just intuitively the way I think about things, right? Most people do, right? They don't think on a fiscal year basis, really. But we look at both, evaluate both, and obviously build programs, mindful of inputs from both of those perspectives.
Thank you.
Anything else from the committee? I don't want to, I'll go to B. Steve, you look like you're okay. Bert, you're okay. Heather, nothing?
I'm
Todd
okay.
looks
How's that?
okay. Let's see here. Let's see if I can do this. There we go. So we'll kind of forge ahead here quickly. I'm going to skip, if you're inclined, there's more detail there on the markets. I'm going to skip ahead in the interest of time. So governance, we mentioned this quarter. This is the third quarter is the one you'll remember where we've got some access to statewide data for both pension plans and OPEB trusts. And again, there's nothing here instructional in terms of having to take action, but it's good perspective, I think, for committees just to have a sense of what's going on statewide. Just a reminder, right? We got this information directly from Milliman. Lisa mentioned already, right, the 6.5% standing return assumption, funded status for each of the 3 plans in the 70, mid 70 and 80% range. They all share the same return assumption, as you know, share the same allocations, share the same manager lineups. And when you take that data at a high level and you draw comparisons to what's going on statewide, you're very much in line with what we see statewide. So as noted here, you'll see the median return, 6.5%. The city, the town's right in line with that. And we'll talk about funded status again in a minute, but you're right in line there as well. I think of note and interest here, remember the pressure that communities have been under, right? There's been a lot of consistent chatter, particularly from the actuaries, but from us as well, right? of being mindful of, on a go-forward basis, opportunities for return. And the pressure for several years running, as you all know, has been one of reduce, reduce, reduce. I do think, and we're not actuaries, but from an investment lens standpoint, I do think we've reached a level now, though, of where we'll plateau likely. I think 6.5% from our standpoint, and we'll do this modeling for you formally in the coming weeks and share that with you early in the new year. I do think you're at levels now that are entirely, supportive in terms of your allocation and expected returns on a go-forward basis. There certainly will be no pressure from us to reduce returns, just given where we stand with capital markets today, particularly with longer dated interest rates continuing to be in pretty nice shape. And I think you're going to hear that same story you may already have from the folks at Milliman, right? I think they are content as well that the hard work's been done, bringing those return assumptions down. And you folks, I know, have done some of that work. And I think you're, from our standpoint anyways, in pretty good working order on the return assumption front. Give me a second here, and then I'll pause and see what questions you might have. Here's just an exhibit that gives you a little color and flavor for funded stat ratios statewide. And again, remember, I'd be a little cautious with these comparisons, right? Every town has different demographics and attributes and might be in different places with mortality tables and other assumptions and, amortization periods. So I wouldn't, to the percentage point, compare these, but you do see generally, right, funded statuses, have kind of been in the low to mid 70s over the last couple of cycles. Again, we looked at your numbers. That's just about where they are. So I think when you stand away from all the data and those two high-level comparisons, you have an entirely appropriate return assumption, and your funded statuses have held in well also, and you're in pretty good working order on those fronts. And then the last thing I'll say, and then I'll take the screen down just to catch my breath and get any questions. The other thing, there's some super high level data here on the OPEB trust front. I would say certainly all else equal that the town is in pretty terrific shape on the OPEB front, right? You'll remember that only about half of plans have even formed trusts and begun to fund the obligation. And you folks did that years and years ago, and obviously have a very healthily sized fund today and are substantially ahead of many of your peer communities, which are still doing kind of a pay-as-you-go type of a structure. So I do think the OPEB circumstances are pretty constructive as well, and you're in good working order there. Any questions on that data? Again, nothing really to act on, or just more informational, but we thought it important at least periodically to get you that comparison so you have a frame of reference when you're thinking about some of the actuarial stuff. Good. Okay. I'm gonna jump ahead here quickly and give you just a quick flash update on performance. I mentioned the town plan. All three plans, as you know, share the same allocations and same manager roster. So the numbers are not identical, if not identical, very, very, very similar. And you see there, as I mentioned, about 6% returns for all the plans. And I think, Lisa, I underestimated you a little bit, right? Year-to-date numbers through September up around 11-ish, actually, a little higher than what I had in my head. And those 20% some odd numbers for the 1 year basis. The relative shortfall in the 1 year number, I think is attributable to, I think, two of the managers. One of them, Newberger Berman. Newberger Berman, if you look at their longer term numbers, they've been terrific. They are been a very kind of thoughtful, consistent contributor to your programs. Over the last year, if you look at the dynamics in the area of the market that Newberger invests in, which tends to be small and mid-cap stocks here in the U.S., they have run with a very high quality discipline. They have very precise measures on free cash flow and balance sheet conservatism and earnings capability. Those are the names actually that have lagged a little bit over the last year. It's been the non-earners and lower quality names that have done well. And that's been a little bit of a relative headwind for Newburgh, but certainly something that's understandable and explainable given the circumstances. So no concern there. And then Barings, your real estate manager, as you've all read and know, real estate has been a tough space for several years running. We're actually starting to see, though, I think, light at the end of the tunnel, and that situation is beginning to stabilize. Barings has done a ton of work repositioning their portfolio away from some of the most challenged areas like real office space. And there's been a measure of stability there, and I think now they're on 3 quarters running of incremental returns over the benchmark, and they said they were going to be particularly conservative in underwriting their program in the downturn, and they've started to see the benefits of that. So both of those managers, a little bit underperforming on the 1-year basis, but nothing I think that will linger or of concern. So we'll continue to forge ahead with them. You've got the allocations here for town plan, just the collection of managers. Remember, you'll see there Dodge and Cox and the Hartford strategies up and running now as your primary managers. The Met West and Western Stub positions you see there are just dividends through quarter end that'll get cleaned up, and those programs will be eliminated entirely. In fact, I think they've already been, the paperwork's been done to do that. Similar Board of Ed, right? 6% for the quarter, same numbers in the intermediate and longer term time frame, same collection of managers, obviously allocations in good working order, no concern there. And then finally, police. And, the story, of course, the same again, 6% return and 20 some odd percent over the last year, and allocations generally in good working order, and kind of consistent with our best thinking. And then finally, just so you've got it for OPEB, remember the allocation here at a high level, similar to the pension plans. The construct here is a little bit different. Remember, we use those indexed ETFs for the time being. But here's what I would say again, right? $25.5 million of invested assets puts you in terrific shape, obviously, in terms of the monies that the town's accumulated to satisfy those obligations ultimately. So you're in terrific shape there, and similar and kind of good returns here for OPEB as well. A little north of 6% in the quarter, actually up 23 on a 1 year, and again, numbers longer term, right, as you would expect, that hover around the indices, just given the all index nature of the program today. And from an allocation standpoint, generally in good working order, right? You see there the diversity that we've talked about in the past, and kind of align with our best thinking strategically in terms of what you're trying to achieve. So I think we're in good shape with OPEB for the time being as well. So with that, I'm going to stop. I know that was quick. We can certainly go back and dive into more detail if you'd like, but happy, Todd, to take any questions from the committee or others.
I don't have any myself. I'm not sure if anybody else does.
I just have one quick one. Chris, with the anticipated reduction in CDs and money markets and fixed income, should we be locking in some of the slightly higher rates at this point in anticipation of those coming down, or are you comfortable with where we are?
No, I think we're, Lisa, good where we are. Remember, the money market, we try to run, you'll remember the process of administering to the liquidity needs. Let's use the pension plans as the focus, right? Because that's kind of recurring in nature. We try to keep those numbers at minimums, right? We'll work with Amy and Kelsey just to have a couple of months liquidity. They extinguish themselves, right? And then we'll raise from where we need to raise to replenish it, to kind of make you sure you've got sufficient monies to make pension payments and the like. And I think within fixed income more broadly, right, your managers obviously are doing that work up and down the yield curve, right, and making those selections. They obviously know directionally what's happening with short interest rates and are positioning their programs accordingly. So I don't think there's any action we need to take. I think money market, right, will continue to drive that very efficiently, keep it to a minimum just to satisfy near-term needs. And again, yields are coming down there a little bit, but remember, in the broad kind of, if you look at the perspective from like a full interest rate cycle, right, they're still actually fairly compelling. You're north of 4% on money market still. So even if we get a gradual turn down there, I think it's something that we can manage in the manner that we've done previously.
Okay.
Doesn't look like anything else. Tyler, I didn't know if you wanted to bring up the deck or you wanted me to keep it up. You're better doing it than me.
I can figure it out. This look okay?
Good.
All right, perfect. So I'll move efficiently through this. Again, I just want to remind folks of our governance calendar. So we always review the investments, of course, but each quarter we have a different different focus, different fiduciary focus. Last quarter we spent some time. This is second quarter. Last quarter we spent some time making sure we had the right types of investment options. This quarter is where we take a little bit more of a look at the participant, the tools that are being provided to the employees of Simsbury. And what we also like to do is sort of a record keeper services update. And so what we did on your behalf is sent along a cybersecurity questionnaire that asks questions that we typically see in the record keeping business, like, is there multi-factor authentication? Are Simsbury employees made whole if there's a breach? Was there a breach over the last 5 years within Mission Square? So those questions were all sent out, and we do that for all 25 different record keepers that we work on. And so you have that for your review. And I'll again, I won't go through each of those questions, but I want you to the committee to know that the answers to those questions are in there. We didn't see any concerns with the answers or the responses for Mission Square. But again, we're happy to have a conversation, a deeper dive if you want to take a look at that from a due diligence standpoint. So this grid here just goes to.
Is that just a survey, or do they actually give you recommendations on things that you need to do differently or anything like that?
So this is what we do is take the DOL's sort of guidance on cybersecurity best practices, right, and what committees like yourself should be knowing or should know around their practice, right? And so they respond to this semi-annually, and so we include that in this deck. This quarter, there isn't a recommendation, if you're asking, Todd, of what the town should be doing around cyber practices. It's really more of how Mission Square is protecting data. But right, to your point, there's 3 prongs to the cybersecurity. It's how Simsbury is sending data. It's Mission Square having that data, but then it's every individual, right, protecting their own accounts. And within the education that Mission Square provides is a lot of best practices around setting up multi-factor authentication proactively, being aware of phishing attacks and other things, because Mission Square will make someone whole if someone is breached at no fault of their own. But of course, most of these breaches, I've had many conversations with record keepers, a lot of breaches are, unfortunately, employees generally responding to a phishing email and giving, their information, and then people going online. Multi-factor curbs that a little bit, because if you provide some of that information, then of course someone tries to take a loan out or take out all the money in your account, something will come up on your phone. But it's still obviously something that people should protect. And I know Mission Square does a good job on advertising or educating around how people can protect their assets. But Todd, this survey, and I'll jump to it real quickly, is more specific to Mission Square.
Okay.
Do they have insurance set up? Who do they use? Outsource that, and they use again SS&C. What types of controls are set up? How much is the insurance? Was there a breach? And again, I won't go through each one of these questions. If you are doing, though, or if the town is doing a cyber audit of third parties, this is a great starting point using this questionnaire. And if there's further questions, we're happy to facilitate a conversation with the experts at Mission Square to answer the right questions that
Thanks, Tyler.
the experts may have.
Todd, just in the past, the Board of Finance has received updates on cybersecurity for the town, and we do ask them how the town itself complies with this survey. We haven't done that in a couple of years. I'm not sure if Amy's on the call, but we can ask her to add it to an agenda. We usually do that in February, not every year, but every few years. So we could get an update on that in February.
Perfect. And Lisa, let us know if we can. We've done many time an IT to IT conversation, because often it's not myself or this group that are the experts, but the other, and even the relationship team at Mission Square aren't the experts, but they know the right people.
Thank you.
And I've been on any of those calls. So this is at a high level the services that you're offering plan participants, and what we use is a benchmarking survey done by Plan Sponsor Council of America. So you offer advice through Morningstar to plan participants. You also offer managed accounts, and I'll talk a little bit about how those work. You get an idea of how many plans your size and the overall survey offer things like advice and again managed accounts. And we've seen an uptick over the last few years of the offering of managed accounts. And again, that managed account tool utilizes the existing funds. It's not additional investment options that they're utilizing. It's the existing menu that we review, but it will manage for a fee individuals' accounts based on risk profile, change in risk profile based on outside assets and other things. And we find that can be really beneficial. And you can see, it's 47% of plans offer managed accounts. And at the higher level, in the billion plus space, it gets closer to 80% of plans offer managed accounts. So we're seeing more and more of that. Again, you offer target date funds, the total number of funds you can see here. There are no annuity insurance offerings, and you get an idea of, how many plans offer insurance annuity options within the defined contribution space, which is minimal. And we are getting more requests around sort of in-plan income, in-plan annuities, and often they're a little bit more higher cost offerings, and there's a little bit more complexity to those offerings within a defined contribution space. But we're happy to have that conversation down the road. And then I did include, given the sort of uniqueness of the plans and the various plans that you have, I think the right side of this, as you design retirement programs, gives you an idea of, okay, what do most retirement plans look like? What, from a vesting standpoint, how many plans offer Roth? And, obviously you do offer that Roth feature, and 90% of plans have the ability to invest in Roth. And then auto enrollments and auto saving increases probably really would only apply to the 457 plan. If you were to create a feature where people would be automatically enrolled into the plan and at a particular rate, as opposed to them proactively enrolling into the plan. And that's something we're seeing more and more, especially in the for-profit corporate space, and even actually in the not-for-profit space as well. I touched on cybersecurity. I won't go into this anymore. I mentioned that again, there's education that's offered. There's advice that people have at their fingertips. Again, advice and managed accounts, the difference is it's point in time. So a participant, employee at Simsbury can go up and say, here are the details of my portfolio and my risk profile, and advice gives you, okay, here's what you should do. And that requires action by the employee. Managed account it sounds just like it is, right? It manages that account ongoing using the same tool that's utilized for the advice tool. And again, this is not someone down the street giving advice and saying, okay, you should probably put all your money here or there. It's an engine run by Morningstar, and we did include our review of Morningstar managed account service here. Again, it's the second largest. It's utilized in 21 different record keepers. What we like about Morningstar is it's not linked to Mission Square. It's an independent engine. So there's no push for it to utilize proprietary or leverage proprietary investment options within the menu. And we're very comfortable with the outputs that managed account tool, plus the cost that's associated with that. Typically, that cost runs right around 40 basis points, and you can see that's right in line with what we typically see on average for a managed account tool. I'll pause there. Any questions around participant offerings? Right here, you get the offering, as I mentioned, the really mega plans. 80% of plans are offering managed accounts, and it is something that we're comfortable having clients utilize. And again, there's no compensation other than to Morningstar for the service, and it's again an opt-in feature. It's not something that everyone has to participate in. Getting into the balances, so the 457 plan up from 15.8 end of the year to 18.5 million. A bulk of the assets in the index, actually, the S&P 500. And then the next highest is the target date funds, and then the Mission Square Plus fund. Now, typically, I see those three funds as the most utilized in many of the plans I work with, the target date fund, the stable value, and the S&P. Rarely do I see the S&P the largest one, but usually it's the target date funds that have the most assets. But here you have the S&P is sort of a third of the assets in the 457 plan. In the Board of Ed plan, up from 1.5 to 1.8. More assets in the target date funds, and then the plus fund, and then of course the index fund, the third one in, and then the 401A plan up from 1.2 to 1.7. And again, given that this is often where people leverage the default investment option, you can see 86% of the assets there are in the target date funds. We spent some time, or a little bit extra time last quarter, talking about how the glide path and the target date funds compare and how T. Rowe Price has done from a performance and risk standpoint. Again, a little noise on the near term, given some of their equity growth assets, but you see over a longer period of time, net of fees, the 5 and 10 year, those funds have been sort of the top performing investment option, and we do have all of those target date funds on and continue to be on maintain. I will mention we've already eliminated the Western asset, as Chris mentioned, in favor of Dodge and Cox, and so that was interquarter this current quarter, and so that will be reflected on the next deck. A couple other funds I'll mention. MFS Values on discuss only that their long-standing portfolio manager, Naveen Chikara, announced that he was retiring May of 2026. Again, the funds perform very well, and we like an announcement like that, and it's just of note so that the committee is aware. The other fund that I'll mention is Vanguard Explorer. Also shifted out one of their sub-advisors. So Wellington is taking over for the Cardinal Capital in that portfolio, and so that is just of note. The only fund that we have on watch is Hartford International. There was a quicker, their PM announced a retirement, and that happened June 24th. Again, that was a few quarters ago, so it was a sort of less of a lead time than that MFS Value Fund. So we're going to continue to monitor that transition and make sure the team is maintained outside of the retiring portfolio. We understand that people retire, of course, and we just want to make sure that there aren't other reasons behind that retirement, and the team remains consistent going forward. So no recommendations for changes or memos are are reflected here, so you can get read a little bit more into detail some of the changes and the recommendations that we have. And I will stop sharing my screen and see if there's any questions.
I would just, Todd, I'm glad, Todd, I'm sorry, if I could, Tyler, that Hartford International Watch status obviously carries into the pension plans own it too. So I neglected to mention that, but thanks, Tyler, for reminding me. So again, no action required, but just an elevated status that we're monitoring, as Tyler mentioned.
Does anybody have any questions for Tyler or Chris? And how long do you watch something like that, Hartford International, before you?
So we have a fund will not stay on watch, Todd, longer than 4 quarters. Sometimes a fund will come off watch sooner than that. Sometimes it will go to terminate if we see something that we're really concerned with. But it won't stay on watch longer than 4 quarters. That's where we either place it back on to maintain or put it on a terminate status.
And that's different from the Hartford total return that we just added in. It was another.
Yeah,
Okay.
different team altogether. Yeah.
Okay. I see it's listed separately. I just wanted to make sure there was no connection there. Okay, well, thank you for that. Anybody else have any questions, anything they want to bring up to the committee? I'm seeing nothing, so we'll adjourn. I thank everybody and hope everyone has a good rest of the year. We will see this committee again on February 4th, the first date that we agreed to, but I know that we'll all see each other plenty of times before then. So enjoy the rest of the day and good to see you all. Bye.
Thank you.
Give everyone.